Now we come to the last major financial statement called the cash flow statement. Now you can understand what a cash flow statement is from the word itself. It basically deals with the cash inflows and outflows of a company over a period of time. So it's similar to the income statement because it tells what did the company do with its cash, what cash came in and what cash went out over a defined period of time, 3 months, 6 months or a year. Okay? Now, why is the cash flow statement important? Well, the cash flow statement is important because the method of accounting that is used to create financial statements like the income statement and the balance sheet is accrual accounting. Now, what accrual accounting basically does is that it lists income and expenses based on economic events, right? Based on an event actually taking place rather than when cash has actually been transacted. So, say for instance, you sell something to a customer and the customer has not paid it to you, you can still list this selling as a revenue in your income statement, although the customer hasn't exactly paid you cash. Okay, so when this is the method that is used to create income statement and balance sheets, it is also very important to see what is actually happening to the cash of the company, whether the company is getting cash or whether the company's cash is actually reducing. Okay, now cash flow statements are divided into 3 segments. The first is the cash flow from operations, cash flow from investment activities, and cash flow from financing activities. So cash flow from operations basically deals with whatever cash is coming in and going out for the running of the basic business of the company. Okay. Cash flow from investment activity means what the company is investing in and what returns is it getting and what returns is it paying. So basically it deals with what the company is doing in the investment side. So if it has surplus cash, how is it using the surplus cash, how is it investing, so on and so forth. Finally, we have cash flow from financing activities, which basically looks into the cash coming in via the financing activities, like raising of capital via a new bank loan or issuing of say fresh shares, and a cash outflow like paying dividends or buying back shares. Okay, so you got, once it is divided into the 3 segments, cash flow from operations, cash flow from investment activities, and cash flow from financing activities, you get a plus value for the inflow that is coming in and a negative value for the outflow. Okay, the same thing is done in the cash flow from investment activities. It sees the plus value, that means how much of cash came in from the investment activities and how much of cash went out from the investment activities. Same story with the financing activities, which show a cash flow statement shows how much of money came in via the financing activities and how much of cash went out. Okay, after getting all these 3, one gets to see in the cash flow statement the net cash flow. The net cash flow. So if this value is positive, that means over the defined period of time, the company actually gained cash. The cash of the company increased. If this value is negative, in that case, that means over the defined period of time, the company lost cash. That means it paid out more cash than what came in. Okay, so this is the basic idea behind a cash flow statement.